Thanks for joining. Welcome to our webinar, How to Qualify Deals Earlier. Most deal teams don't lose deals because they missed something. They lose them because they found it too late. Welcome back. My name is Jonas Moortgat. I'm the Customer Success Manager at openthebox, a private market data platform with real-time business information on Belgian companies. You can put your questions in the chat already. Just as always, our moderators will look into them. And if you don't get to your questions today, then you can expect an answer via email in the next few days. Here's the scenario I want you to sit with. You're 3 months in a certain process. Numbers looked right, sector made sense, target passed its initial screening. Then somewhere in around 2-3 of your due diligence, something starts to feel off. The ownership structure is messier than it first looked. The person you've been talking to is not the actual owner of the company, and the financial picture traced back only a few years, maybe 2 years, tells a completely different story. None of that is actually new information. It was all there from the start. The process just wasn't designed to surface it before you were months into that whole deal process. And every deal team thinks they have the qualification process. Everyone checks the financials, does the same background on ownership, tries to understand who's making decisions on the other side as well. The problem really isn't that these checks don't happen. The problem is that they, or when they happen, actually. In most workflows, the deep qualification work only starts after a significant commitment has already been made into the whole deal process. After a partner potentially already has spent time on it as well, after an NDA might have been signed already, and after a relationship has been built, it's really hard to walk back from at that moment of time. We covered the cost of this in our previous webinar, my colleague Seppe. The number when you actually build it is almost always higher than expected. Not because the direct costs are shocking, but because the indirect ones really start compounding over time. Senior advisors, time spent, advisory fees, relationship capital on both sides, not just your side, but also on the client's side. For an outcome that was, in most cases, actually predictable way earlier than it might have seemed at first. So I would say this pattern really is consistent. Problems don't just appear late, they get found late. I think that's where the major difference between those two is, because the process wasn't really built to find them early to begin with. And there are 4 categories where this plays out almost every single time, and that are very repeatable over time. So these are 4 signals basically that aren't new to anyone in this room. I can imagine, of course. So you've got the financial trajectory that you want to look into, the ownership structure you want to research on, decision maker alignment, and then of course more external risks you want to discuss or you want to find out on beforehand. So the question this session is really about is not just what to check, but more when to check and what it costs when the answer is month 4 instead of week 1. So a deal screened out in week 1 costs you almost nothing. Time spent is very limited. The deal or the same exact deal pursued for, let's say, 6 months already costs potentially hundreds of hours and millions in fees down the line. Every firm, of course, checks all of this eventually. The firm that performs better on deal economics are the ones that actually do these checks first. When people hear, just qualify earlier, the instinct is to assume that it means just more work up front. You need to check more things up front, more steps, so a process that is completely slower, this way slower actually. But it's not really what I'm trying to describe today. What I'm describing today is more of a sequencing of work you're already doing with sharper go and no-go criteria that operate before the process properly actually begins. So before the whole diligence has started already, before advisors have stepped in to the game, and before even momentum starts taking over from actual decision making. There are 5 things you should be able to answer definitely with confidence at this time. The first one, does the financial trajectory support actually your thesis of this deal? Not just the headline, the trend, and the cash conversion of the story underneath. The second one, I would say, is about more the structure, the ownership structure. Is it navigable? Not just who owns the company, but can a transaction actually close given how it's held today? The third one, I would say, is, of course, have you identified the real decision maker, and not just the person who took the first call, but actually the person who is going to be involved in closing the deal as well. A fourth one, and also a very important one, I think, is are there any structural red flags that you can see that might change the risk profile of this specific deal? We're talking about regulatory observations, reputational information, or maybe cross-holding complexity that would require remediation before any deal would even close in the end. The fifth and last one, but not the most important, but also one of the most important ones, I think, is that does the information that you currently hold actually support the valuation range you're working to, or is pricing at this point just an assumption instead of based on real cold hard facts? Of course, I'm not trying to say that any of these questions are new questions to anyone joining us today. Every experienced deal professional, of course, is I'm assuming nodding right now, because these are really the questions that kill deals in late diligence every single time as well. What I think is new is actually forcing your team to answer them before you've already committed the whole team in further research and committed in general on this specific deal. So when firms will start mapping their failed deals against these 5 criteria that I just went over with you, the pattern is almost always the same that we notice. The signal was there in the financial picture, in the ownership layer, the decision maker dynamics that were at play. These were all points that were probably already visible from the start, from the get-go. I would say that the major difference between catching it early and catching it late is not just talent. We were talking about any of your talents today. It's more about the process and the data infrastructure that makes early processes possible.
So let's make this very concrete indeed. Let's say we're going to open a box and looking for a company like MediaFin. Imagine MediaFin would have bad numbers or numbers that would not get you excited, or might even ring some alarm bells. So we'll go to financials and we can find the overview, but also find the annual accounts available in openthebox. Just imagine these numbers would be all red or wouldn't be as great as they are right now. Would you still continue after finding all of this information? And how long would it actually take you to find all of these annual accounts and have them in one simple overview in openthebox? We can go to the spider app, and right here we can already see the people that are actually making the decision. Not just the people we get on the phone at first, or the first people we get in touch with when reaching out to open conversations about a potential deal. These people are the actual people that are owning the company, people that will be able to make decisions moving forward with your deal team. The view on the participations will show us what other companies might be involved. Do any of these shareholders have blocking rights? Any of the participations that are letting alarm bells go off? All of this you'll find right away without needing to look up all of the different annual accounts or without needing any further research outside of openthebox. So if you were to find all of this information and we find companies with any blocking rights, would you still continue with your research down the line? Next to that, we can go to the news section. Is there any bad news, negative press about the company that you're researching? Are there any bad or negative press articles that are letting any alarm bells go off? Right here, you can find right away without needing to Google or without needing to research again outside of openthebox. So with these news articles, with participations, with administrators all visible, and financial information being both positive or negative available right away on one platform, how quickly do you think you can actually make decisions compared to what you're doing right now? How quickly do you think you will be able to decide whether a deal is worth pursuing or not? That's actually one of the core values that Open Box is trying to pursue.
So then I have one question to leave you all with today. For every deal your firm progressed to full-on due diligence in the last 2 years that didn't end up closing, was there a point looking back where the information needed to stop was already available? It just might have not been looked at just yet. And to be honest, for most teams, the answer I think would be yes in this case. That's not today. We're talking about a people problem. It's just how today most deals or most deal workflows, I should say, are built or are set up. They're optimized for execution instead of optimized for execution once a deal pursuit is made, and they're rarely optimized for actually the quality of the decision itself. If a deal ended up failing late, then it wasn't a late failure. It was an early signal that wasn't acted upon early enough in the whole deal stage. So if you're not sure if your team would catch these signals in week one, that's really the gap we at OpenBox help close today. Or if you'd like to see how this applies to your own pipeline, for example, make sure to book a demo with me or send us an email. Links, as always, are right available in the chat. Then I just want to thank you for your time today. It was very great seeing all of you again. I hope it was useful and speak soon. Bye-bye.